going to be spending a lot more time in here with you lot. Because I love it in here. I fucking love it!
Well, well, well. Look who showed up.
Barely.
For those of you who don't see behind the scenes of what's happening in this show, we were about to go live with me and Tyler. Jason nowhere to be found. And as the countdown hit 3, Jason popped up his beautiful little face. So thank you for joining us, Sunshine. We appreciate it.
I would be dying if I wasn't just a tirade of expletives when none of my headphones were working, and now I've got these at least like plugged in and hopefully working, but it looks like I'm delayed on the camera, so even better.
Yeah, it is, reset the counter, Tyler. Scuffed count back to 0. Days without accidents. Just, whew. All right. Well, welcome everyone. This is the Pirates of Finance. We are your co-hosts. That incredibly handsome yet lagging man across the virtual table from me is the one and only young Hemingway Jason Buck. I am his co-host, Corey Hoffstein. This is the show where we ostensibly talk about all things finance, economics, markets, business, but we never really get around to that stuff most of the time. It really just takes a hard tangent into things that'll likely get us canceled one day. But what it certainly isn't is advice, not legal, not financial, not accounting, not tax, not marital, not religious or spiritual. Just, make sure you seek out professional help, not from 2 rando guys chopping it up on a Friday afternoon. Jason, welcome back from Global EQD. What time did you get home?
See, I got back at like 7:30 Sacramento, and then drove. It's another hour and a half back home, but like stopped for some dinner on the way. So it was nice to reacclimate with a nice dinner in Napa Valley. But you left at what? Well, you left the hotel, I saw at like 10 a.m. You probably took you a while to get back. And let me guess. Well, I did see your tweet. So did you get caught in Dallas, or I saw you were upset about the naming conventions in Dallas?
So Dallas confuses me, and I'm glad I tweeted this out. So if you're in DFW and you get on the SkyTrain, you would think that it would be like you go from gate A to B to C to T to E. But if you look at the loop, it actually goes A, C, E, D, B. So like it makes sense if you read it top to bottom, left to right, where it goes A, B, C, D, E. But if you're going in the SkyTrain and you're like, oh, I got to get from, I don't know, D to C, they're actually not next to each other. You have to like go through these like A or E. It really hurts my brain to think about when I'm on the SkyTrain. Turns out there's actually a reason for it. It's not just like, Texas being illiterate. Shout out to Texas. No, actually, I have a lot of friends in Texas. It's not, it actually wasn't like, I assumed it was just because the way the terminals were built originally that they added more terminals on later, and it just ended up being sort of a situation of sprawl and growth. It's actually because the way you drive into DFW, which is something I've only done a couple of times. Most of the time I just fly through there. When you're driving into DFW, you actually go through the middle of the terminals and you branch off left and right. And so from that perspective, driving in, it actually is alphabetical and makes a tremendous amount of sense. It just makes 0 sense when you're on the SkyTrain. So that's that. Got home late night, 11. My son slept beautifully last night, though. It was awesome. I got 6 hours. It was phenomenal.
There's some that it's clear then too. Yeah, if you've never really deplaned in Dallas, what's always throws you off, but then it starts to make sense once you get used to it. Is like how they have individual baggage claims almost for like each like just group of gates and everything. So when somebody is coming to pick you up, like you said, it bifurcates the car services, and then you go to like almost individual pickup outside of baggage claim. So it's a very unique airport in that sense. By the way, shout out to Key Pagan Rush that said he's joining. Pagan Rush is joining live for the first time ever.
Oh, we love it.
Thanks
for joining us.
Yeah, and I think Rob SFO also said first time listening at 1x speed, aka live. So those are
Well, this is going to be a spicy episode, Jason, because we're
Well,
going to bring up some things
before we get to
said.
that, no, before we get to that, and I'm not trying to delay that, but you did. It was nice for once for me to be on West Coast, as far as flying in and out of an event where, like you just said, you left at 10 a.m. when I saw you, and you didn't get home till 11 p.m. And like the coast to coast stuff just sucks.
Well, and part of it is my local airport doesn't have a tremendous number of direct flights, so I had to do like the extra 2 hours of not only like layover time, but it wasn't a direct flight, so the whole triangle hypotenuse shorter than the legs type situation. So all in all, I think I just probably added 3.5 hours to my travel time, plus 3 hours, of clock time, and it adds up. So,
but you also said that before we get there, your wife also said like, well, at least you'll be away from the baby and you'll get some sleep. And you were like, had to correct her. It's like, we don't get any sleep at these events. It's just 24/7 conversations. You're lucky to get 6 hours if at best. And
not only that, but I was dumb enough. This is classic Corey travel. This is some real insight into my life. Travel is my kryptonite. As the world gets back to travel, the number of times I'm going to tell you about the travel mistakes I make on this podcast, people are going to be like, wow, this guy is really just probably needs to hire an executive assistant because it's all pretty bad. I mistakenly scheduled a fund board meeting on East Coast time for 9 a.m. East Coast, which is totally reasonable. Not thinking that I was going to be in Vegas and it was actually going to be 6 a.m. So, I called it an early night. You and I went to dinner. We got back very early. Like, I think it was like 10 p.m. Crawled into bed. Got woken up at 4 a.m. by some pretty loud banging. I'll leave it at that. A euphemism. Some pretty loud banging on the wall. Banging that was happening, which woke me up, and then I had to get up at 5 something for this 9 a.m. Eastern fund board meeting. So all in all, I'm pretty dumb. I should have realized I was going to be on West Coast time and scheduled that for later in the morning. But there we are. So my wife thinks I go away on trips to get some sleep, and I get far less sleep than I do at home with the newborn. And nobody's going to cry for either of us, but it's thoroughly confusing to my calendar every time when I'm switching back and forth for East and West Coast, especially at that transition. It's like, so you're trying to set up times for Zoom calls in the future, but like you're currently on East Coast, then you go to West Coast or vice versa. And I can never get it right. And my schedule is always messed up. Yeah, the tiny violin is definitely playing for us. All right. I'm actually going to spare you. We'll see. There were some. No, you're not. No, you're not. I'm going to spare you. We're going to go into a different topic. There were some things said at dinner that I actually do think are fodder for interesting conversation, and I'm not going to throw you under the bus for saying them because I think you put them out there as a bunch of people chopping it up at an investment dinner. I know you like to say things that are perhaps controversial for the sake of just getting a conversation started, but I want to start in a different direction because my buddy Jake on Twitter, who goes handle Econompic. Shout out to him, by the way. He doesn't post as much as he used to. He actually has a brilliant old blog. He used to blog a ton during the financial crisis and the years after. He's got some gold in his old blog, but he does these really fun poll tweets every once in a while. And he had a couple this week that I thought were really interesting that I wanted to ask you about that are just like these hypothetical questions. And some of them are meant to be, there's a clear answer and you have to think about it. And other ones are like, there might not be a clear answer. Like some of these are pretty tough and maybe there's some loopholes to think about. And so here's an open-ended question for you. Are you ready? Yep. Would you rather be given $150,000 a year in cash every year for the rest of your life, or an unlimited Amazon gift card that can be used for the rest of your life? You and your immediate family are allowed to consume, or would need to consume anything that you buy from Amazon. So you can't resell the goods, can't give them away, no tax write-offs. Your family has to consume the goods. This is a tough one. It's actually a tough one. So I would think this is much more subjective. It shows your personal consumption habits. And given how much we use Amazon currently and thinking about the future, unlimited use. So like every year you can charge whatever you want, but like you can't use it to like sell to other people, right? Like so you, right, whatever, households, good food, everything, you could just order it through Amazon. It's unlimited, right? So you could spend $500,000 a year on Amazon if you wanted in this scenario, right? Just so I understand.
I got to take the Amazon unlimited Amazon gift card.
So this is an interesting one. A couple thoughts came to my mind immediately. One, the way this is set up is one of these has no inflation hedge to it. One of them is an inflation hedge, right? The Amazon gift card, you're going to get a pass through of inflation in the consumer products you buy. The other thing that came to mind was, okay, what is the actual breadth of goods that are available on Amazon? Like, can I buy a car on Amazon? Turns out you can't. Here's another loophole. Can you buy gift cards on Amazon?
Yeah.
It turns out I don't think you can buy gift cards using a gift card. Like, I don't think you can use an Amazon gift card to just buy like a Visa gift card. So that was one loophole I was looking at. The other question, though, is Amazon going to be around for your entire lifetime? Right? Like, what is the credit risk that you're inherently taking on in this trade? And finally, like, how much shit can I actually buy? Like, at the end of the day, like, how many rolls of toilet paper do I actually, like, am I ever going to be able to consume more than 150 grand of whatever I can buy from an Amazon store? Like, what am I going to get a brand new flat screen TV every day? Like, at a certain point, I'm not even sure I can consume that much.
There's several things you point out there. First of all, shout out in the comments to Arna. Arna's listening in I don't know if Arna's in Switzerland right now, but I can hear you, Arna. I can hear you. He knows what that means when I say that. But and then in the comments, actually, David asked, can you buy AWS credits with your Amazon gift card? That's an interesting question, right? For that possibility.
I don't know.
So I think
start a business using your
yeah.
That's interesting.
Yeah. And so
this is the line of thinking I like.
Well, what I like, your line of thinking, I think is the way to look at it is like future inflation, right? Like, let's say I get lucky and live for another 30, 40 years. And what's my Amazon basket of consumption over the next 30, 40 years? To your point, what's the credit risk on Amazon being around? So to me, that's the bet you're making. We're like, what is 150 grand worth in 30 years?
Right.
You know, like, let's say right now you're consuming, let's say 25 to 50 grand on Amazon. You don't know in 30 years if you're consuming the equivalent of 250 to 300 grand.
Right. I mean, you can get what the market expectation is, right? You can sort of like go price that out. That I will tell you, I actually started talking with Jake in the DMs, and I said, where I'm thinking about this is, how deep is the credit default swap market on Amazon? And is there a way in which I could use my gift card nefariously to try to buy so many goods that for them to fulfill it, like, it would create like a pricing whipsaw effect that I can try to drive Amazon out of business? Like, because you would think like okay.
So you're saying millions a month? Is that what you're trying to say?
Well, I'm like, yeah, I'm just going to take this to absurd levels. Like, can I buy some credit default swaps and then really push them to the brink of, like, they need to take on an absurd amount of debt to fulfill the size of my orders? I think the reality is they would just sort of say, well, the item's not available. Like, I think they're pretty insulated from me trying to. So I was trying to think of creative things like David said, can we buy AWS credits? Like, what else can I do other than buy consumables, discretionary and staples, that would actually create, like, can I manufacture a return somewhere else?
So 2 things on that. One, I love this. Like, Corey creates a question that he's thought about for 48 hours, has a bunch of answers to, that then asked Jason on the spot. So I appreciate that.
It makes me sound very smart.
Yeah.
Wait, hold on. I sent this to you at the beginning of the week.
I didn't have time to look at it.
And said, we're going to talk about it on Friday. Don't you throw me under the bus just because I prepared.
But then is that in the spirit of the question? Like, how can I bankrupt Amazon and buy CDS? I don't think buying CDS on Amazon was part of the question, was it?
Well, I'm sorry for being creative. What? Like, what? I don't see it not being part of the question. The question was, which one would you rather have? And so my thought is there something I can do with the gift card that would generate a higher net present value than that 150 grand, nominal annuity? I mean, 150, like that, it's, again, you're talking about taking the gift card. Like, I honestly don't think you spend anywhere close to that.
I'd have to look at it. Yeah, no.
Right.
Like, I was thinking about inflation. Yeah.
You can't buy plane tickets. You can't buy, right. You can't buy, like, you pay for your housing.
Do you know how much liquid death water I buy?
That's true. does it say, I'm trying to think. So you can't resell the goods. It doesn't say you can't barter the goods. It doesn't say you can't barter.
Oh, here we go. But just that reminds me of like the reason you can't buy gift cards with gift cards is like, did you ever, maybe kind of was close to a decade ago for like the credit card churning? Like if you went into like subreddits on like credit card churning and like buying gift cards and then reselling the gift cards or using Amex gift cards to pay yourself back, it's why like all the local grocery stores have like a $100 limit on like Amex gift cards because that was like how people were churning credit card points.
Like I was thinking about like what's like the most expensive thing you can buy on Amazon? Then I was thinking about, well, are there things like collectibles that you could just buy an infinite amount and guarantee that you get the rarest one eventually? Like so as an example, like Pokemon cards or whatever, like, you know, like could you just buy out the entire thing and you guarantee yourself getting the rarest ones eventually? But then you're not supposed to sell that good. So you'd have to like the question doesn't say you can't barter it. Doesn't say I can't start a museum and charge people to come visit my museum. Like I'm just trying to think of creative, none of which really in my mind ended up exceeding the 150 grand annuity.
Well, actually, I think you're going here's another direction I would think of is you could build a house with everything you could buy on Amazon. So I could build a house, then that would be great. You sell unlimited. I could even start a construction spec home company based on everything I could just buy off of Amazon to build those houses.
So yeah, but you have to consume the goods.
You personally, but at least like building a house alone would be, you know, pretty valuable depending on like what, you know, how you
but you could
FF&E and everything.
I mean, how big a house are you going to build versus okay, you wait 3 or 4 years and then you have your down payment in 150, right? You collect 450 grand. I don't know. We haven't talked about taxes, but you collect your 450 grand, use that as a down payment, and then you're paying off your mortgage every year with 150 grand you're getting. You could get a pretty damn big house.
Yeah. Depends on what kind of palace you want to build. You got an unlimited Amazon card.
Yeah. I mean, if you think about this, I mean, it's not inflation adjusted, but you know, you do the 4% rule, right? You're basically saying the 150 grand a year, you're retiring with 3.75 million, right? It's basically saying you got 3.75 million. You're going to carve out 150 grand a year to pay yourself. Now it's not that 3.75, that rule doesn't really apply because it's not like the 3.75 million is growing,
right?
But you're also not drawing it down. You're just guaranteed 150 grand. I don't know. It was an interesting question. I think I'd go with the 150 grand. There's way more optionality in my mind, but I think there's probably someone far more brilliant than me who can figure out a serious way to game the answer with that Amazon gift card.
Well, okay, so I was with you when you were basically moving into your new house or had just moved in, and you had been gone for a little bit, and we came back. And the amount of Amazon packages at your front door, like what would you be just your guess on the amount of Amazon packages a week you get to the house?
I don't even want to know. But it's not like it's nowhere close to that much money though.
Yeah.
It's just that we live in a consumer era where it is easier for me to say, "Oh, I'm out of toilet paper," and instead of going to the store and buying toilet paper, my wife just hits like buy the toilet paper that we need, and it shows up in mass bulk, and we have it for a month.
All right. By the way, we got an update from David. He said, "Corey, you can build data centers with the Amazon card." So there we go. See,
that's what I like. That's okay.
Now we're on to something.
Yeah. Now
by the way, I can't remember I brought up with you before. Is like, to me, if I'm a neighborhood kid, like young teenager or whatever, instead of doing, I don't know what they do anymore. I don't even think they mow lawns or shovel snow anymore for the neighborhood kids. But if you had a neighborhood job, I think the modern version of that is I will come down and break down all of your Amazon packages and put them nicely into your recycling bin. And therefore, you don't have to break down any more cardboard. I would pay dearly for that.
All right. So here's what you do. I've got this. You buy a shitload of puts on Amazon. All right. You then use your Amazon gift card to buy a massive amount of data supply. I'm trying to think of this through. I'm trying to think how this works. No, it's not going to work. I was thinking if you could resell the supply for less, like basically force them into. No, this was a dumb idea. I was trying to figure out how you could force them to use the servers at a lower cost, at a earn less than their cost of using them, but the amount they charge, they're just always going to make a profit. All right, ignore me. Next question from Jake. You ready?
Yeah.
These are fun.
These are like what's the other ones where like people do this as a troll farm though? As far as like doesn't like Sweaty Startup do that though? It's like, or other people are like, do you want $20 a day or like $1 million in cash or whatever? Like, wasn't this
Or
like a big controversy?
tomato
Like,
farm. Yeah. Sweaty Startup says that. Okay. How much would you pay for a brick of gold that is a current street value of $800,000 if you could never sell it, melt it, give it away, borrow against it, etc.? Basically, you can only ever look at it, and it will be thrown into the bottom of the ocean upon your death. How much would you pay for that brick of gold?
you can only look at it and it's thrown in the ocean. You can never sell it. You can't use it as like it's totally valueless, right?
Yeah, I mean, so my brain, I mean, the etc.
You can use it as collateral. You can't use it as anything, right? I'm trying to read the question.
Anything, yeah. I was like, well, could you use it as the basis for a futures contract and deliver it? Could you use it to create shares of a physical gold NFT? Excuse me, a physical gold ETF, not NFT. But I think the etc. in this question pretty much captures like you can't do anything with it.
So is this just like a subtweet of like Buffett's idea of gold? Or like we just dig it out of the ground, then we dig a hole in the ground and rebury it? Like, is this what he's trying to say?
Yeah, I don't know. It's sort of weird because I think he's just like, well, how if something is currently marked as being incredibly valuable, but if you hold it and you're not allowed to do anything with it, there's no utility and there's no reselling, and after death it gets thrown to the bottom of the ocean, assume never to be recovered again, like, does it have value?
There's two things on that. One, I want to outsource my brain to David Taggart today. He said I would rent it to rap videos and TV stuff. I was like, he's on it today. He's talking about building data centers with your Amazon card.
I like that, but I think that's captured in the etc. Like,
right.
You can't look at it. You can't rent it. Like that was like David. You're thinking the exact same way I'm thinking, which is like, where's the loophole?
But also what you said about throwing the ocean, though, did remind me, but if you can't borrow against it or use it collateral, is like, the old like cowrie shells and wheels and stuff they use in the South Pacific allegedly for money, is sometimes those would get lost at sea and they'd be like, yeah, on the sea floor, I have 20 of these big round wheels, and they would use that as collateral for barter on the island. And like, so but if you can't borrow against it or use it as collateral, like you said, you're just looking at it, I guess, or you're using a paperweight.
Yeah. And like, I was like, again, I think renting it out, I was like, I don't know, could you give it to a museum? Is there a tax write-off thing you can do with it? I don't know. I think the answer is probably zero.
Do you have, well, I guess $1? Like, do you have an actual, like, I guess that's the other fun part of the game. Like, would you put any sort of even value on it just as a collectible for yourself? I guess.
Well, that's where it's like, just like, how much is it just fun to have? And here's where I come down to. I think it becomes too much of a liability, right? It's not like it would be like, oh, let me get my brick of gold and have it in the middle of my family room for everyone to see. It's like all of a sudden everyone knows you have an $800,000 brick of gold.
So this
all of a sudden you gotta pay up for a security system and you're gonna get burgled. So now you're going like, what's the fun of it?
First of all, burgled was just a great word.
You're gonna get hamburgled.
You get hamburger, Luke. The other thing is, like, I think you have excellent point here. You should get paid to hold this, right? Because you're gonna like defend against all comers. It's a liability. It's no longer an asset. Yeah. Not only is it a pet rock, it's now a liability.
Because I was thinking, I was like, I would pay $20 and then I was like, no, I wouldn't. I don't want this thing. It's not something I want to own. If I like, it's just too big a risk, too big a target. Like if you were like, hey Corey, you can have $1,000 gold coin, sure. Right, I can keep that on my desk. It'd be fun to have. Like I would pay $10 for that. But
I like Sean's throwing into it. Can it be insurable? I guess that wasn't in the question too. I guess that'd be somewhat.
Have it insured and then hope someone steals it. Yep. Make it very stealable. Theft-able? What's the word?
Just keep it in your front yard. But it's
I'm sure. And then you just got to deal with some insurance fraud claims. But I think, again, etc. here kills the spirit of the question. All right. last and final question. This one's along the same vein. I actually got a little hat tip for this one. So Jake says, how much would you pay for a gold ETF? So currently $80 worth of gold per share of the underlying. But the underlying gold is not accessible for redemption. So you can't redeem your share for physical gold. And this is an interesting additive. That gold will be thrown into the ocean at some random point in the next 50 years. So it's gold backed, but at some random point, that gold that is backing it will just be dumped into the ocean.
And then you just have the paper trade on the ETF,
You've got
right?
the paper trade. Yep.
Well, and what would you pay? So this is like going in an entirely different direction. So I would argue there's always levels to the game. Like as far as like I don't mind the gold ETFs with all the conspiracies out there and everything, because like in semi-dislocative environments, you're going to see the paper gains on the gold ETF and you can convert that to cash, whatever you need. It would take highly dislocative events where you actually need the physical gold. So you could argue, I can see the argument of people. It's like, I only need the paper ETF. I actually never need the physical. And then the other question is, if the physical gets thrown in the bottom of the ocean, what happens to the value of that paper ETF? Like I said, if it's not attached to it at all, isn't that just going to increase the value because you're reducing supply?
Well, but if in
Depends
theory,
on what you're tethered to.
The value of the paper ETF is supposed to be tied to the fact that like there is the gold backing it. For every dollar, there is supposed to be $1 of gold backing it. The question is, if it was never redeemable in the first place, does it matter if that $1 of gold backing it is in a vault or is at the bottom of the ocean? I would argue yes, because while it may not be redeemable by you, it doesn't mean it's not redeemable by others. If the spirit of this is it's
right.
never redeemable, well, it still doesn't mean that the ETF couldn't, as a fund complex, couldn't be closed and liquidated. So it has value. Once you throw it in the bottom of the ocean, and assuming it's irrecoverable, right? That's the whole point. Like,
right.
I don't think Jake's trying to say like, okay, like, create a treasure map and someone can go find it. Like, shoot it into space, shoot it into the sun. Like, it's irrecoverable. What do you have? You've got a paper copy that points to something that no longer exists.
That would be a tangent. Yeah, go with your butt. Yeah.
But there's that interesting, like, thrown into the ocean at some random point. So here's where it gets interesting. I like financial theory for me. If it were trading at a discount to the actual fair value of gold, what you should do is someone should buy all the outstanding shares, right? Or buy the fund company and liquidate the ETF. Trying to think of the right way to do that. Like, you can't redeem the shares for the gold, but I wonder if you could buy the company, buy the RIC itself and liquidate the associated, like buy it all out. And then do you get the gold? In which case, it has to be arbitrage. That arbitrage would bring it up to the value of gold itself, like the $80 per share. So I'm not sure it could be worth zero, but anytime it trades below zero, or trades below 80, someone would say, well, I can just buy out the whole company and there's an arbitrage here, at least for like, you got to factor in expenses. But I'm not actually sure that's how it works. I'm not sure you can buy out an entire RIC like that.
There's also been a lot. There's been a lot of comments in the section too about like shorting it or buying puts, that sort of thing. It's like, to your point, now you're getting into like closed-end fund territory, trading at a discount. Is there an arb there?
Right. Well, yeah. Like, should this thing always trade at zero? To me, it like either kind of always has to trade at 80 or always at zero. But I haven't worked out the logic in my head of like, if there's an arbitrage to unlock it. If there's an arbitrage to unlock it, then it's got to trade at 80. And it's going to be weird when the gold gets thrown in to the ocean. Or it always trades at zero. But I don't see how it could trade in between. I might be missing something, though. Anyway, I love these questions. These are the great questions that should be asked when you're 3 drinks deep at a finance conference. Instead, Jason.
I was waiting for it. I was just letting you, giving you the opening.
Instead, what kind of questions do we get at dinner at a finance conference? Eating some very spicy Thai. I will actually say, I will say, for what did we order? 8 out of 10 spiciness?
Yeah, it wasn't that spicy. Yeah.
I thought it would be way spicier. I was like expecting to be the little weak baby at the table who had to like order milk or something. But
No, I would have been right there
able.
with you. I would have been right there with you. Yeah, I was a little nervous on the 8 out of 10, but it was probably more like a 6 out of 10 at best.
Yeah. So I know you. I'm gonna you were poking and prodding, trying to create a little controversy at dinner, and you asked the question to the table: does anyone think that they can create 20% annualized returns going forward, like somewhat indefinitely? Right? Was the question? It wasn't like not next
20%
year,
CAGR.
like,
Yeah, 20% CAGR over like a few decades.
or a few decades.
Sure.
And I think most of us at the table were like, that sounds insane. I mean, I think there's obvious limits of like how much capital you could do that with, right? At a certain point, the compounding becomes like,
Oh yeah.
okay, you are now the entirety of the market. So clearly it's not possible. You know, I don't think you were talking about doing it with $10. But you didn't put any limits on it. Like you didn't say you have to do it with public stocks. You didn't say like you couldn't use leverage. You said just like given the free chance, do you think, and I didn't even think about the capital thing. Like if you give me $1, do I think I can do 20% CAGR on $1?
Yeah.
I don't know, maybe. Like,
well, yeah. So I didn't give you the capital. Yeah, I didn't give you capital constraints or anything. It was just thinking more about the context. Well, once again, like you said, like what we're going to talk about the debt ceiling at dinner. No, I want to talk about something a little more fun. We're drinking, having a good time. Let's throw out some crazy ideas. So then the idea was it's related to, you know, Buffett's returns, etc., and or you hear about CTAs in the 70s, or even, you know, distressed debt PE people in the 90s. It's like they were putting out outrageous returns, but also the risk-free rate was much higher. So it's more a question. Yeah, you can use any asset class, leverage you want. Yeah, don't worry about capital constraints. Start as small as you want, grow as big as you want. Like those sorts of things. That was more the question.
So here's where my head went when you asked the question. So I'm of the view, I and this is because this is the world I operate in. I tend to operate in the world of slower risk premia that have a Sharpe or an information ratio of like 0.3 to 0.5. I think it is impossible to combine those to get to a point that you could get a 20% CAGR. You said, well, what about leverage, right? Can you get enough diversification that you could potentially lever them? And I'm of the view that what ends up happening is as that diversification drives vol down, it drives your excess return down as well. Like at a certain point, you become so diversified, you get rid of all your risks everywhere, and you just get a very expensive risk-free rate. What really matters is what is, like you talk about MAR ratio a lot, right? Like that CAGR to drawdown. I think what really matters for this question is not your MAR, but probably like your excess MAR. Like what's your excess, your CAGR of excess returns, like after subtracting the risk-free rate over your drawdown, because that tells you how much you can really lever up, right? And I think what ends up happening is when you get so diversified, you end up having an excess return above the risk-free rate that shrinks and shrinks and shrinks, so that even though your MAR ratio may go up and up and up, your excess MAR ratio goes down and down and down to the point like you'd have to lever up 50 times that little premium above the risk-free rate, right? So an example here, if none of that is making sense because I'm speaking gibberish, is like think about super short-term high-quality credit, right? Super short-term high-quality credit has a pretty decent MAR ratio. Like when I say short-term, I mean like sub 1 year, very high-quality paper. Like the drawdowns and that stuff is very limited, but the excess return above treasuries is also very small. So like you're going to have a super high MAR ratio, your annualized return to your drawdown. But if you try to lever it up to get to a 20% return CAGR, you're going to have to lever it up 20, 30, 50 times, right? At which point you're probably going to hit a path that will blow you up eventually. So
just LTCM basically, right?
Yeah. My gut reaction was no. In the world I operate in, doesn't mean there aren't worlds in which it's possible, right? We talk about like pod shops and high frequency.
Right.
that are going to be like, somewhat capital constrained. But for the uncapital constrained style premia, risk premia, I don't think you can do it.
Yeah, so there's two things in there. One, and just to reiterate MAR ratio again, it's your CAGR divided by your max drawdown. And I like to see a MAR ratio that's more like 2 to 3 decades plus, because like a MAR ratio over 3 to 5 years doesn't matter. Actually, over 3 years, it's actually technically count MAR ratio. But like you're saying, like there's two caveats to it in the sense that like, can you create a diversified portfolio like you were saying, but the MAR ratio is good, say it's MAR ratio 1 or even better, but it's about what is the return over the risk-free rate. And let's just say it was, so then the second part of that question would be, let's say it's 5, right? And so let's say you're at 5 with like, let's say you knew that max drawdown, even though you couldn't know. Let's say it was a max drawdown of 6. Would you, in that scenario, lever it up 4 times? That's more the question. And then the other caveat being, like you said, like we have plenty of examples, Rentec, high frequency trading, pod shops, all sorts of things with, like that have produced 20% returns kind of regardless of the risk-free rate. But that's kind of a separate conversation that I think we're having at dinner.
Yeah. Look, if you said to me, I know for a fact the max drawdown is 6%.
Yeah.
And I have an excess CAGR of 5, of course I'm going to lever that up, right? Especially,
but what would be the number? What if it's 10? What if it's 10?
Yeah, look, in my life, I'm willing to take drawdown risk of about 30%. Like that's where I'm comfortable with the drawdown in the capital I have. So that's where I try to aim for the appropriate level of risk. Do I want to have that drawdown? No. But if you told me my max drawdown is 10, yeah, I'll lever that up 3 times.
Well, the hard part is we can never know max drawdown, but I think that was more the implicit subtext of my question was like, how were you guys thinking about your own risk profile? And how are you willing to use leverage to what would be your trying to attenuate to your max drawdown? It was more about that than anything else.
I'm not going to say who was at dinner, but I know they're listening. And I bet they're shaking their head right now with you saying that's what the implied question was. That's bullshit, buddy. That's some bullshit. Your implied question was, do we think we can hit 20% CAGR? It's interesting, right? But I think that, okay, what CAGR are you confident you can hit over the long run? Right? I think that's an interesting nuanced question. Like, is it higher than 5? I certainly think so, but it's less than 20. Where's my confidence band, right? Where's my expectation and where's my confidence band?
No, I think that's an interesting one. Yeah, what's your confidence interval for the CAGR you think you can hit long term? But going back, I will push back in the not bullshit side. Is that's why I always bring up MAR ratio. Is like, if you could produce 20% returns, what drawdown are you willing to handle? Because that's implicit in that question.
Right. Look, I think the people who have those sorts of returns are of one of two styles, in my experience. They are either trading very, very high frequency strategies, like they're market making, right? And often those are highly capital constrained strategies. So it's not really a CAGR. Like, yes, they're doing 20% per year, but they're not compounding, right? They have to keep pulling capital out because it's not something that scales. So I think that's like a very different thing when someone says they're posting 20% per year, but it's not a compound 20%. Or you get the people who are high vol, right? And they have massive P&L swings. And they win big and they lose big, and maybe they're compensated for it over the long run. But, they can have those mega 70% drawdowns.
They just to clarify, and I do want to come back to your confidence interval band of what you think it could do, but like just to clarify for those who don't know, like Rentec shut down to outside, but also they shut down because they're capacity constrained, and then you're kicking back cash, and they need to find places to put it. Similar things have happened actually with Susquehanna, with SIG, Peak 6, etc. Is like they're now hit their capacity constraint ceiling, and they're just spitting off cash, and they don't know what to do with it. I love that SIG ended up just starting a VC in China and accidentally or purposely, invested in ByteDance, and then made another few $1 billion off of that. So like it's a good problem to have, but also to your point, like what I'm saying is like I usually throw those out, right? Because none of us are running an HFT firm. We're not doing any of those sorts of things. So that those are kind of inconsequential. At the same time, I'm wondering how you think about because I think it's really hard to find people's MAR ratios. And so, for example, even if Rentec is allegedly put up like 60% plus CAGRs, I've seen a max drawdown in the 30% range during the quant quake, but I don't have exact data. So I think it could be more than that. So one, I don't know what they did, but it looked like Ed Thorpe was producing a MAR ratio of 1 over multiple decades. But how do you discount, like, Ed Thorpe was able to figure out warrants and options before they even had Black-Scholes model? Like, that's how nascent the markets were. And do you think we're in a fully developed market, and then the only way you could find those like nascent arbitrages is in crypto? Or like, do you think they exist anymore in TradFi and we're just too lazy to find them?
No, I definitely don't think we're too lazy collectively to find them. I think, again, that stuff gets more and more difficult every year. I think that's why so many people opportunistically from the TradFi world jumped into crypto, was because there was a large pool of investors at the table who were not as sophisticated, and you saw a huge amount of like taker behavior, just non-price sensitive retail investors jumping into meme coins that either on a centralized exchange and market makers were making a fortune, or a decentralized exchange where mev bots were making a fortune. Right? Like, just sophisticated parties were able to extract a tremendous amount of value from people who were operating with a very different utility function. They didn't mind paying a 2% spread because they were trying to buy a meme coin that they thought would go up 1,000%. And I think those opportunities are short-lived at this point. Like the idea that crypto is speed running TradFi. You saw a lot of people print a tremendous amount of money in market making over the last couple of years. And many of those parties that I speak to now will tell me that the opportunity has largely disappeared, right? Doesn't mean they're not still making money. It's just not nearly the amount it was 2 years ago. And so, again, they might be able to print a massive number or a couple of years, but they're not doing it for decades and decades and decades in that same space.
Well, yeah, that's an excellent point. Is like whether you can still find some in TradFi, but they close faster than they do in crypto, but those arbitrages always close. And so the question is, like, you want to be an arbitrage hunter for the next few decades? Like, it's a tough business.
I mean, we mentioned HFT. It's like, we just sort of go, oh, HFT can do this. Well, yes and no. I mean,
right.
How many high frequency trading firms have shut down over the last 20 years? I mean, there's like 5 major firms now. They've all consolidated, gotten bought out. I knew people that were doing, HFT options, market making for a decade, that the firms eventually just couldn't compete anymore with the Citadels of the world. Like, they just, like, the edge dissipates, things get more competitive. That's the nature of markets. I think it's great. You can be Ed Thorpe and print for a decade, maybe 2, but I think parties are getting more sophisticated. Information travels faster. There's the social gamma. I think the edges likely get dulled faster. That's just my hypothesis.
So going back to, let's call it an 85% confidence interval, what do you think you could put up a CAGR over the next 3 decades?
CAGR or excess CAGR? I want to talk excess CAGR because, like, okay. I don't know what the risk-free rate's going to be. So right. I think that's sort of like an unfair thing to talk about. Right. I feel pretty confident. I could build a portfolio that does pretty consistently 500 bips over the risk-free rate, 600 bips over the risk-free rate,
with
safely, like with a high confidence,
85% confidence interval.
Yeah, like plus or minus 250 bips. Like, I feel pretty confident. As you push higher, as you're like, okay, Corey, give me 800 bips above, like, that confidence interval gets wider.
That's surprising me. You went more aggressive than I would. My first thought in my mind was like 300 bips or 3%, thinking that Harry Brown permanent.
Well, my first answer is I can give you the risk-free rate with 100% confidence, right? And then and then it just goes down from there. It's a question of how wide does it get, how fast.
But I was thinking, like, I think it's since like 72 Harry Brown's permanent portfolios produced like 3% real. And so, like, just using that as kind of a benchmark, but also with the caveat of, like, started in 72 when you came off gold. Like, there's a lot of even caveats to that. So I don't know. I think if you look at a lot of meta studies,
the Harry Brown permanent portfolio is crippled by being 25% in the risk-free rate. So,
Yep.
right, you take that and you say, okay, get rid of the risk-free, like maybe there's some, I'm not going to say rebalancing premium, but maybe there's some diversification premium being earned there. But you've got 1/4 of your portfolio in your risk-free rate, which is a drag on the excess returns you can generate. So if you were to take the other 3 sleeves and scale them up appropriately, right, you're getting a boost of I don't know, another 33%.
Right. And do you think like
So
I think
so you've got
Meb's
400
done-
bips from gold, bonds, and stocks equal weight?
Yeah, I think Meb's done a lot of backtest studies on this on like the different portfolio constructions with broad diversification, but you end up in that like 300 to 500 bip range, right? Of
So what
real
did I say?
return.
500 bips with a decent amount of confidence?
Yeah, yeah.
So I don't think I'm that far off.
So once again, if you could produce 500 bips with a decent amount of confidence, would you lever it up 4 times?
But you didn't ask me what the drawdown was.
Exactly. This is why my point wasn't bullshit earlier about it was attenuating to draw down a MAR ratio.
Yeah, but okay. Okay. Again, I don't think if you're getting 500 bips, 600 bips above the risk-free rate,
Yep.
trading the stuff we're talking about, right? That Harry Brown permanent portfolio, if you get rid of cash, right, you scale up the other 3 sleeves, you've got periods of pretty meaningful drawdowns, like 20, 30%.
Sure.
Right? So how much can you actually lever that? 2 times? Like you're not getting anywhere near 20.
No, I agree with that, what you're saying, but you changed a little bit because in your mind, even if you don't want to say it publicly, I understand, but like you're thinking in your mind to get 500 bips, you had some kind of construction in your mind, which I would bet is a little more complex than Harry Brown's permanent portfolio. So that's what I'm saying. Pick a drawdown number for that 500 bips, and then that's what we could determine what you would be comfortable leveraging, right?
I think that 500 bips, like I think 15 to 20% drawdown is just going to be the natural salient sort of amount of ambient drawdown. I don't know. Like I'm not sure for the stuff we're talking about, right? If I do some combination, say of stocks, bonds, managed futures, right, as a very vanilla example, I'm not sure, even if you do a very thoughtful sort of portfolio construction of that and lever it up, well, yeah, I still think you end up with like a 20, 30% drawdown for 500, 600 bips above the risk-free rate.
You're saying with that, so you changed from like, I was saying if you were at 15, 20, like you would say 2x leverage on your 500 bips. So you're saying you think even at the 500 bips, you're still going to probably in a 30% drawdown range.
Yeah. Yeah. I don't think I can get to 20 with stocks, bonds, managed futures, gold. Like, I just don't think there's an asset allocation that gets you there. Even with, you do your factor tilts, all that sort of stuff. Like, I'm not seeing it.
Well, the other thing is we moved into real versus nominal, right? And MAR ratio, just to clarify, is more based on, nominal versus real. So that's why we're expanding what the MAR ratio is obviously truncated if you're going with the real versus your
yes and no. I sort of look at it as if we're talking about the excess being about the risk-free rate. Risk-free rate does a pretty damn good job of protecting your capital against inflation, right? Like, people always talk about, the purchasing power of a dollar has sucked over the last 100 years. Like, it's down X% because of inflation. Well, who the hell is just keeping their money in cash in their mattress? Like, if you put that in T-bills, it hasn't been eroded at all. That's kind of the point. And so if we talk about the excess return, I think we kind of are in a proxy of real space already.
I also think, though, you're highlighting something that we talk about privately often. Like, for example, I was on a call before this, right? And we were talking about periods of underwater in like the US stock market during the 1900s, right? And like, when, going back to our previous conversation, do you remember, do you assess it based on price return? Do you do total return? Do you count dividend rebalance and reinvestment? And then how good's your data for the 1930s, when dividends are running higher, et cetera? Now you got a data problem. But all that is like your peak, obviously your peak to trough, like underwater periods. If you're looking at that generally, you're going to be like 1930s, obviously 1970s. But if you adjust for real, it's actually like the 1960s to the 1980s is like your peak underwater periods. And so even though you and I would like to adjust for real, I'm not sure clients ever look at it that way.
I think inflation is one of those things no one thinks about until it's really big. Like in the US, yes, inflation has happened every single year. Have I thought about it? Have I considered it largely? Okay, this is where I'm going to get smacked down again. Corey, you live a privileged life, and yeah, I'm just waiting for the DMs to hit me. But I think for the most part, right, other than those periods like when oil spikes and it's really obvious gas prices go way up and it really hurts to fill your car at the pump, most of the time for the last 20 years, most people haven't really thought a ton about inflation. And so they just care that the nominal return is high enough, right? In talking to a lot of advisors, there's like that nominal return blindness. And it happens like they talk about where clients care. Like if the market's up 30 and clients are up 20, they don't seem to care. Like they're up big double digits. It's a big nominal number. It's enough. Like it doesn't matter they underperform by 10%. They got some big number that they're very happy about. Versus if they're down 5%, they're very upset. It's really interesting, the behavioral aspect of sensitivity to this stuff. But I think, again, when inflation's running super hot, I'm not so sure your average investor putting money in their 401k thinks about how that translates into their investment returns.
Yeah, that's what I'm saying. I don't think the average investor, your client, and hopefully you find the right client so that's not your average investor. So that's a whole other topic of conversation. But I think it's interesting. I don't want to speak for you, but I think we think about it the same way. It's like, I want to compare returns after inflation. So I want to compare real returns. I also want to compare them after tax as well. Like I want to know what my true bottom line net is. And then that's how we compare across that. And like, so 200 analogies to that. I don't know if this is true, but I've heard Brits quote their like personal income after tax, like on a weekly basis. And at least they quote after tax. Or the other analogy we were talking about in Vegas, you and I were talking about, was like restaurants and everything. Like that price for that, I don't know, that ribeye on the menu is not the real price, right? You got to add in tax, service, everything else on top of that. It's like we just live in these fictitious worlds where we're not talking about net.
Well, tax is a really hard one. And this is one I struggle with and have struggled with. Because when you run a fund, right, say a mutual fund or an ETF, you don't necessarily know who your investors are. And you don't know what kind of account they're buying you in. So the question is, what is the appropriate thing to do? Like if I as an example, have an alpha signal that says buy one stock, sell another stock, but the stock I'm selling is 20 days away from going from short-term cap gains to long-term cap gains, should I defer that trade, right, knowing that my alpha might decay to avoid incurring the taxes? And that's actually, I wrote a paper, very non-trivial math goes into it. This was when I was smarter in options theory. It was like some very weird binary options pricing concepts that went into the paper. I can try to dig it out at some point. But the point I'm making is you have to make a decision as a manager. You either care about taxes or you don't, and you make that explicit to your investors. I think the majority of managers just say, I'm not going to care about taxes. I am going to tell the investors I am tax agnostic, and it is up to them to appropriately do their asset location. Now, ETFs have a wonderful innovation in the create redeem mechanism that allows them to wash out a lot of potential taxes in the turnover through custom baskets. They can do that with equities. They can do that with bond capital appreciation and index turnover. They can do it with options now. Can't do it with futures. But it's an innovation that keeps expanding, and it's a wonderful tax dodging thing that doesn't exist as easily in mutual funds. Turns out it does exist in mutual funds, just not quite as easy as it does with the ETF mechanism. Long story short, the point I'm trying to make is like, this is something that you talk about, well, what's your return after tax? It's such a personal question, right? Everyone's tax rate is different. Like I might make the right decision for someone with a super high tax rate, but I have an investor with a low tax rate that actually was a wrong decision for them. Like, so I have to assume some sort of average tax rate. Like none of this is an easy thing to contemplate when you're running money.
You just said like you're compounding with the vehicle, so like you in essence you have to be tax agnostic, but also like what we were talking about with whether it's ETFs or classical 60-40 portfolios is, okay, you have that full tax rate and then everybody's worried about churn at like that full tax rate and taxable account, but like what if you're setting that up in your self-directed IRA or your 401k? Then it's not taxable. So like you said, you don't know what the perspective they're coming from. The other one that you and I both traffic in, and most people don't even realize, is like managed futures 1256 contracts are taxed at 60-40, 6% long-term, 40% short-term, no matter how often you trade. But you're also taxed every year. There's no like set it and forget it and not have a taxable consequence. It gets netted out in your K1 every year. So that's why you can't know the perspective they're coming from. You can't know their tax rate. So it's like, one, it's like we can never quite figure that out. And then two, similarly, like this is why all of it's we try to figure this out, but it's also BS because we don't know every individual's tax representation vehicle they're using or actual other ordinary income. But the second piece is like you know, I keep talking about real. There's no like, what is real? Like, what's the inflation rate? Is it CPI? What is it like? Like we don't have an accurate number for that as well.
Right.
And so like we're just trying to figure this all out, and we use these things as like a proxy, but the map is not the territory. So like we're kind of like all over the place. And then especially if you try to have me forecast future inflation rates, and is that going to be in CPI? Are they going to change CPI next year, next decade? I don't know.
Yeah, I mean, talk about forecasting future inflation rates. I think if you went to the Philadelphia survey of professional forecasters, which, by the way, like if you look at the way different quant firms try to estimate what is like real yield in a bond, like they don't just look at historical CPI changes. They obviously, some of them will build their own baskets and try to calculate CPI on their own. Like using a forecast of survey of professional forecasters is one way people try to estimate forward CPI changes or forward inflation beyond like market derived inflation swaps and that sort of stuff. And if you look over the last 2 years, I think they were pretty horribly off what actually happened with CPI, right? But then again, you go look at CPI versus, you know, quote unquote, trueflation measures that are trying to measure what actual inflation is in the economy and not using lagging measures like rent and that sort of stuff. And trueflation measures today are starting to say that actual inflation is closer to 3% than what's getting quoted in month over month and year over year changes in CPI. So again, to your point, like what the fuck is inflation?
Well, part of it is like you said, we all have our individual tax consequences. We all have our individual CPI basket. And that's why it's so hard. Like the way you and I spend is totally different. And so and now that you have a young kid as well, it's going to be totally different, which also makes me want to go
basket is like 90% diapers. That is my inflation basket.
It does make me want to go back. I'm gonna have to like think about this over the weekend. Is like, if I had that unlimited Amazon gift card, like what do I really think like I could really rank up on that? Like what would be the spend? Like if you really were just maxing out all your purchases on Amazon for you and your family over a given year, like how high do you think that could potentially be? I'm gonna have to go back and like to really think through that one.
There is some real genius to what David said of using the gift card to buy out servers that you then. But you got to think about like, okay, so I'm going to go back to this for a second. So you buy out all the Amazon servers. The question is, what do you do with them? Like, you either need to set them up for compute that you're earning money from the compute. Like maybe you're running a bunch of Bitcoin clusters, because you can't rent them out and charge a premium, because people would say, well, why don't I just go to the Amazon directly, right? So like you can run a data center, but you can't really charge a premium on the data center unless you're offering a service that coordinates. There's some value add. So I'm thinking about like, okay, what if you just buy a shit ton of data servers and spin up a gazillion Bitcoin and Ethereum nodes?
But the caveat being, like, didn't you guys just break the handcuffs if your family has to consume it?
Why am I not consuming that?
You're starting a business that, like, yeah, you're going to consume the money you make from your music.
Wait, hold on. I'm using the gift card to buy server time that I am consuming.
You're not consuming it though. Why
am I not consuming it?
You're not. You guys just broke the covenants of that question, but because you're not using it for a consumable.
David, let's connect in the DMs. I'll give you my Amazon gift card. We'll get this thing going.
How do we get one of these said gift cards? This is it's like Cuban getting like the was it American Airlines, was it like unlimited first class travel plus companion for life?
So do you know, speaking of like infinite things, there is a like, I think it's a gold medallion. If you own a ski mountain, you belong to like this secret club of ski mountain owners. And there's like this gold medallion that you can basically use to go ski any other ski mountain in the US.
I wish you would have told me this. I actually was just hanging out with the guy that runs Ski California and that whole like lobbying group. I should have asked him. That would have been a great question for him.
Yeah. And the reason I know is I happen to know someone who owns a ski mountain that has one of these secret gold medallions.
But have you ever seen like they did the economics of all those people that bought those American Airlines passes, and they've been doing everything they can to break the contracts with those people because it's just insanity.
So here's the question: if you have one of those secret gold ski medallions, how much is it worth, and how much would you display it for in your house before you get burgled? All right, with that is the end of our show. I hope you all enjoyed. Thank you for tuning in. I will say, given summer coming up with a significant amount of travel, Jason and I will be continuing the show. Unlikely we will be doing it live, though. We're going to have to do a bunch of pre-recorded episodes. We're going to have some time zone changes, traveling abroad, that sort of stuff. So we're going to do our best to keep the show going, keep it going live, or at least going live at 3 p.m. Eastern on Friday, but we will be pre-recording. But I really appreciate everyone tuning in. Last thing I'll say is, if you enjoyed the show, you know, this is something that Jason and I do as a passion project for love. We're using it to bootstrap a rum company eventually. But part of that is we have to grow this channel. And what we ask of you is to fulfill the Pirate Pinky promise. And that Pirate Pinky promise is that you are going to hit like, subscribe, drop a comment, tell a friend, help us grow the profile of the show. Leave an inflammatory comment. The algo loves that. Get some banter going back and forth. And we appreciate it. And with that, Jason, anything to add?
Yeah, I was just thinking we need like a QR code or something. I'm going to Bottle Rock this weekend. I'm gonna see like how could I finagle that up on the screen. Let everybody in the audience know about pirates, you know, about the Pinky Promise. Get it up there on the big screen while Posty's up there singing his little heart out or something. That'd be great.
Well, you enjoy that. All right, everyone. Thanks for tuning in. Enjoy your long weekend if you're in the US. Enjoy your regular weekend if you're anywhere else in the world. And Tyler, take us out.